financial management, functions of financial management overview and decisions, and the objective of financial management. So I hope during this session I will be able to make you understand about all the aspects of the financial management. And furthermore, I will cover the second unit of the time value of money, and the third unit, the risk and return analysis. So welcome you all once again. So why the first thing comes in our mind, uh, if we are studying the financial management, so first word is finance. So why do we need finance? Why finance is too much important? So as you all know that the finance is the lifeblood of any of the organization. From the establishment to start of the business, what is the first thing comes in your mind? Which is finance. The second aspects where we need the finance to run the business survival. So for running of any of the new business and for the survival of the existing business, the finance is also required. And the third aspect is to expand or modernize or to diversify. When your business is already running and you want to expand that business, that for also the finance is required. If you want to modernize your business, for that purpose also the finance is required. And if you want to expand your business, diversify your business from one unit to multiple units, for that perspective also the finance is required. So to buy assets and to intangible or tangible. For all the purposes, if you don't have money, you cannot purchase your assets, whether it will be tangible or intangible. For buying of the assets also, you must have to need to accumulate your finance. And for day in day out activity, if you have managed all the finance, your fixed assets, but you don't have the money for survival or day in day out. And for if we are talking about the business perspective, if you don't have the working capital, you cannot run your business smoothly. So that's why the finance is the as I have already explained you, finance is the lifeblood of any of the organization. And without finance we can't think for the business and for their survival. So you can understand now how much important the finance is. So if the finance is too much important, so we should also understand how to manage that finance efficiently so that we can maximize our profitability of the business, which is one of the prime objective of the business. So moving ahead, so the many authors has defined the financial term financial management in the many way. Here I have comprising some definitions of the financial management given by the renowned financial analysts and the authors. The financial management, as you know, the comprises of the two words. One is called the financial, and another one is management. So financial means, what do you mean by financial? Financial means procuring sources of money, supply and allocation of these sources on the basis of forecasting and monetary requirement of the businesses. And what do you mean by management? As you know that management refers to planning, organizing, coordination and control of human activities and physical resources of achieving the organizational goal. So finance and plus management will give you the better result of proper financing, and proper management will give you the better result of management of financial management. So Ezra Solomon has defined the financial management in his words: the financial management concerned with efficient use of an important economic resources, namely capital funds. It is the study of the problem involved in the use and acquisition of the funds. So basically, the financial management is comprises of the management of sources of fund and the utilization of fund. So that's why there is another definition is also given by another authors. Financial management is concerned with the planning and controlling of firms' financial resources in order to achieve the objective of the firms. So for meeting the objective of the organization, financial management play a very important and crucial role for the business and the organization. And that financial management comprises forecasting, planning, organizing, directing, coordinating and controlling. I hope you must have clear till now. So under all the activities relating to the acquisition and application of the financial resources of an undertaking in keeping with it is called financial objective. So this is the another definition given by Raymond Chambers, right? So, when I have already discussed about how much important financial management is, so we must be analyze what are the functions of financial management, what type of role a financial manager play inside the business, inside an organization. So there are various functions of financial management. Here I have listed few of them. So for the first function of the financial management is estimate required capital. As you know that the for when you are planning for starting of the business, expansion of the business, modernization of the business, what is the first thing comes in your mind? How much finance will be needed to do all these activities? So estimation of the capital, estimation of the first fund is the first and foremost important function of the financial management. After the estimation, once you have estimated the amount of the capital required for the business, then the second things comes in your mind: how will you acquire that capital? What will be the capital structure? It means the determine the capital structure. So what will be the capital structure? Here I am going to explain you in brief that what do you mean by capital structure? Capital structure is nothing, it is the combination of the various sources of the capital. Suppose in our capital, we have procured the funds in the form of equity, we have procured the funds from the form of debenture, we have procured the fund from the owner's fund, from the bank loan, like that. So there are various sources of the capitals available in the market. So how much capital, from which source and how much capital you are acquiring, depending upon the cost effectiveness, depending upon the availability of the firm. So determination of capital structure is also very very important aspects of the financial management, right? And after that, the third function of the financial management is evaluate and select the sources of the fund. Once we have decided whether we are going to be financed with equity, capital, or debenture, borrowed fund, and own fund, and then we will decide which source is giving you the best result. And the sources we should select while acquiring the finance, the source must be available in time at the reasonable level of cost. So cost is also the important aspects of taking the financial decisions there in the financial management. And after the evaluation of the sources, the next step is allocation and control funds. Allocate and control. So whatever the funds we have acquired from the various sources, we must be allocate that funds efficiently so that it should not be the underutilized, right? So allocation and controlling of funds is also a very important aspects of the financial management. And then next one is distribute the profits or surplus. After investment or allocation, whatever the earning you will get from your investment, that earning you must have to be distributed among in the form of dividend, or some earning you must be kept as in a retained earning. So it is also important, if you have earned from your investment and you are not going to distribute your shareholder, you are losing the trust from your trust to the shareholder. So distribution of profit in the form of dividend is also important. So distribution and profit and surplus is another important function of the financial management. And the last is the monitoring of financial activity. When you have completed all the previous functions of financial management, but if you are not controlling over the last function, which is monitoring of financial activity, your all exercise will not be give you the good result, right? So monitoring of financial activity is also an important aspect of financial function. So these are the important function we had discussed just now. Now moving ahead, how a financial management and department of financial management in any organization work, and what is the prospective and what is the core financial decision, what are the core financial decision they can take during in the financial management part. So financial management, the first and foremost, the objective of financial management is to maximization of share value, and the second part is to take the financial decisions, and that decision depends on investment decision, liquidity decision, financing decision, and dividend decision. And that dividend decision and investment decision and all decision are the trade-off of their risk and return. If you are investing wisely, if you will invest wisely, you will get the return, good return, and then you will reinvest your return, so then you can minimize your risk of your investment. So all the are interrelated. So this is the overview about the financial management. Now moving ahead, what I have already discussed, these financial decisions. So all the financial management is basically depends upon the three decisions. These are the core three important decisions of the financial management, and all entire financial management is revolving around these three decisions. When you will take these three decisions correctly, you will get the better result for your future, and you will achieve your goal and objective of your organization. The first decision is investment decision. Under the investment decision is comprises of the capital budgeting and working capital management. And the second one is financing decision, which is the cost of capital and capital structure. And the third one is dividend decision, which I have already discussed, the sharing of profit among the shareholders. So what do you mean by capital budgeting? I am going to explain you in brief here. Capital budgeting is a part of investment decision. There are multiple projects available in the market, but which project will give you the better result, which project is profitable for you. So how will you decide? You will decide on the basis of analysis of capital budgeting. How much amount should invest in that particular project? So this will be analyzing by the capital budgeting, and there are various techniques of capital budgeting. On the basis of that, you will analyze which fund or which project will give you the better result. There are the techniques like net present value, payback period, the techniques IRR methods, there are technique like ARR. There are various techniques you can use while selecting for the proposal for the capital budgeting. And the second important and one thing also I want to mention here, the capital budgeting is related to your long-term investment. But if you are focusing more on the long-term investment, but you are neglecting the focus on the short-term investment, which is the working capital management, you may face the liquidity crisis in your future. So like the capital budgeting or investment decision in long term, it is also very important aspects to manage your working capital management in your business, because it gives you the day in day out business capital, and on the basis of that you can run your business smoothly. And moving ahead, the cost of capital, if you moving ahead for about the financing decision, the one it is comprises of the two part. One is called cost of capital and another one is capital structure. So the cost of capital is the cost involved and the minimum amount of return from the investment, so that you can meet the requirement of the cost of the fund, right? So cost of capital is nothing like that. When you are acquiring capital, like equity share capital, and equity share capital, you must have to pay the dividend to the equity shareholder. When you are acquiring the capital from the debenture, you must have to pay the interest to the debenture holder. So this interest is the part or for the cost for the company. So whatever, so from your the agenda of the business, from your investment, at least you should get the return at from your investment, which is equivalent to your cost of capital. right? So this is also important aspect. There are various sources available in the market, but which source will give you the cheaper source of capital, you need to decide or analyze also. And the capital structure I have already explained in the first slide. It is the combination of the various sources available for your financing, right? So these three financial decisions are very, very important for the business. Now moving ahead, I have already explained these things in the previous slide. You can see the overview from here. Investment decision as to which assets and firms would acquire, where to put the money. So you can analyze with this picture also what do you mean by investment decision actually is. The second part is financing decision. The financing decision is related to where from you get the fund. From where you get the fund, finance decisions as to how to raise the funds to pay for the investment in the assets. And the third part is dividend decision. It is related to decision as to how much, how frequently, and in what form of return cash to the owners. How you are going to uh, pay back to your owner, your shareholders. If they have invested the money in your company, they have trusted on your company, you must have to give some reward, and that's reward you are giving in the form of dividend. So this is also an important aspect for the business or the financial management. Okay. So now let us discuss me about what are the objectives of the financial management. As we have already covered the importance of financial management, functions of financial management, but why we should do too much attention, for managing of finance or financial management. So basically, there are two core objectives of the financial management. One is called profit maximization, and another one is wealth maximization. So let me start or begin with the profit maximization. The main aim of any kind of economic activity is earning profit. When we are thinking for any of the business idea in our mind, what is the first thing comes in your mind? When you will get the profit, when you will start getting the profit, when your break even of your business will start, will happen, and you will realize the profit after that. So the first thing comes in the mind, return in the form of profitability. So a business concern is also functioning mainly for the purpose of earning profit. So it is, but obvious it is an objective of every business. Profit is the measuring technique to understand the business efficiency of a concern. If suppose you are understanding, how you understand that these two companies are different in their form of profitability. The company is earning more profit, this company, as per your point of view, this company is doing good, their financial position is good. So this is profit is also a parameter of measuring which is doing good, which is doing bad, which company is efficient and which company is inefficient. So efficiency can be measured by profitability also. Like suppose if two students coming in front of me and I have to analyze which one is good student. So first of all, what I can do that, I will ask their percentage of last or previous semester exam, and I can understand which the student who is saying that his or her score is higher, he or she must be intelligent than the other. So this is the like that analyzing of the comparison of the two students. Similarly, the two company can be analyzed on the basis of the profitability. So it is measurement of the efficiency also. And profit maximization is also the traditional and narrow approaches which aims at maximize the profit of the concern. Profit maximization approach was the old one. Traditional approach, there are another objective has played an important role and supervise the profit maximization role, which is known as the wealth maximization. So why wealth maximization is superior than profit maximization? There are certain arguments in the favor of profit maximization. There are certain arguments in the against of profit maximization, and on the basis of that, the conclusive point will be there. The wealth maximization is the superior objective than the profit maximization. So I'm going to explain you what are the favorable points of the profit maximization. The first favorable point is main aim is earning profit. every business is earning profit. Sometime what you can do that, and what organization is in practice to doing that, they can reach to any of the level, extreme level, they can beyond the rule and regulation for earning or making more profit, right? Like tax hiding of the tax, hiding of income, paying less tax. So these are also are the part of how can you increase your profitability. So another favorable point of the profit is the parameter of the business operation. Profit, the third point is profit reduces risk of the business concern. If you are making more profit, whenever any of the contingency or any of the problem happening with your business in future, you can reduce your risk of the failure. Next one is profit is the main source of finance. There are various sources of finance in the company, but if you are investing or in any of the project and any of the proposal, any of the financial institution, what is your main earning? Your main earning is the profit. And then the profitability meets the social needs also. So because the profitability is also important, so you can meet the society needs, social needs whenever it is required. So these all are the favorable points for the profit maximization. Moving ahead, there are some points which is given against the profit maximization objective, and on the basis of that, these against points make the wealth maximization superior than the profit maximization. So what are these points? The number one is weight. As you know that the profit is vague. In any of the business organization, there are multiple level of profit, operating profit, gross profit, net profit, earning before interest and tax, before tax profit, net profit after tax. So there are various level of the profit. So when we are talking about profit, on which profit we are talking about, it can be not be, it cannot be clear from the statement when we are talking about only the profit. So operating profit may be less, and net profit, operating profit may be higher, but net profit may be less. Why? Because if you are doing the too much expenses, operating expenses will increase, then the net profit will definitely will decrease. So profit, word profit is the weight. It is not clear from their statement to which profit we are talking about. The second part is neglects the time value of money. Now, it is a very, very important. We will discuss in the next few slides in the unit number 2, time value of money, why it is so much important. Because money is also the investment value. When you are investing today on getting the return in future, until the time the inflation will moving parallelly, and your whatever you will return in the future, the valuation of that return will not equivalent to how much you have invested today. So the time value of money is also important. So profit maximization does not consider the time value of money or the net present value of the cash inflow. Now the profit maximization treats all profit as equal irrespective of the timing. So timing is not mentioned while calculating the profit maximization. And the third aspects of against the profit maximization is ignores the risk factor. So profit maximization ignores the risk factor also. Profit maximization does not consider the risk of the business concern. Risk may be internal or external, which will affect the overall operation of the business concern. And the fourth point is absence of social consideration. Profit maximization implies exploitation of the consumers, workers, and their society. It creates immoral and unfair practices. Sometimes I have already told you just now. Sometimes the business and organization for making their profitability or more profitability and increasing the profitability, they are not giving the proper compensation or proper remuneration to their employee. They are trying to hide the income from their taxation policy. So these are the social consideration, absence of social consideration in the profit maximization. Okay. Now we have discussed about the profit maximization, their favorable point, their against point. Now what is wealth maximization? So wealth maximization is the objective of, it is also very, very important objective of financial management. And nowadays it is so much important. Every company want to maximize their wealth rather than maximize their profitability. So wealth maximization is the objective of financial management, refers to the maximization of the wealth of the shareholders, and NPV. What do you mean by NPV? Net present value of the investment. When we are investing today, and whatever we will return get in future, and the difference between the initial investment and the future return as per the analysis of time value of money must be positive. The one should not invest in the project where the NPV is negative, right? So NPV is the present value of cash inflow minus present value of cash outflow. It can also we can also write that benefits minus costs. So these are the what are the important aspects of the wealth maximization, and we can say that what are the favorable aspects of the wealth maximization. So wealth maximization ensure availability of funds. The availability of funds at the proper time of need is an important objective of business. The organization will not be able to function without funds, and activity will come to a halt, right? So wealth maximization will make sure any of the business and the organization, the funds will be available on time, so that your business production or your continuation of the business cannot be harmed. Then second part is attain the optimum capital structure. To maintain the optimum capital structure, a perfect combination of debentures and share is required. The organization will not want to give away too much equity and also control the cost of capital. It is a delicate balance. So optimal capital structure means utilization of resources optimally. And if we are financing or using the only the equity share capital, as we know that equity is a costliest source of capital, and debenture, if we are financing 100% of the capital by the debenture is also risky in the form of, because it is a fixed rate of interest. Whether the company will be earning profit or not, the debenture holder must be receive the interest. So it will be create the fixed interest cost for the company. So there must be the balance between the equity fund and the debenture fund. So the capital structure should made in that way. So there is a delicate balance should be equity and debenture. And then the third part is effective utilization of funds. So funds may be utilized effective. As I have already explained you, there should not be the underutilization and there should not be the overutilization of the funds. So business not only needs a large number of funds, but also a skill to handle such large amounts, to cut down unnecessary cost and to save funds from wasting in useless assets in crucial or the businesses. Okay, so there should be effective utilization of fund. And the next part is ensuring the safety of the funds. The wealth maximization objective ensure that your funds must be safe, and security of the funds through the creation of the reserve also. The chances of risk in investment should be minimum possible. Sum of reserve created for this purpose are sinking fund, general reserve, etc. So these are the favorable points. Now the favorable arguments for the wealth maximization are superior to the profit maximization. Wealth maximization is superior to the profit maximization because the main aim of the business concerned under this concept is to improve the value of the wealth or the shareholders. If the market value turnover of the company will increase, the wealth maximization profitability will increase. So it is more superior than profit maximization, and I have already explained in my previous slides how profit maximization is vague, how it is not considering the time value of money. So these are the several points. On the basis of that, we can say that the wealth maximization is superior. Another point, it has already mentioned here also, time and risk. So the profit maximization is ignoring the time value of money and the risk for the business. So that's why wealth maximization consider both time value of money and for the risk of the business concern also. Efficient allocation of resources. Wealth maximization provides efficient allocation of resources. Usually accepted, the concept of wealth maximization is universally accepted. To ensure the economic interest of the shareholders implies financial institution, and safety. So this is the favorable points of the wealth maximization. There are few unfavorable points also against the wealth maximization. Link, there is no direct relation between financial decision and share prices. Ultimate aim of the wealth maximization objective is to maximize the profit. So it is one of the unfavorable point. Only possible with the profitable business. Wealth maximization can be activated only with the help of the profitable business on the basis of on the business concern. And frustration, it may lead to management anxiety and frustration also. So these three are the unfavorable or against of the wealth maximization. Now, in this slide, I am going to explain you how the financial management or finance manager functions in any of the business organization. So what are the organization of finance function? So it is starting from the board of directors to delegating the responsibility to managing directors, and then managing directors delegates the responsibility to the different departments like production director, purchase director, finance director, personal director, marketing director. And furthermore, the finance director has the two branches where they are working on the basis of that. One is called treasurer and another one is controller. And the work of the treasurer, work under the treasurer is auditing, which is credit analysis, pension management, and cost management. And working role of the controller is planning and budgeting, cost and inventory, profit analysis, and accounting and payroll. So these all are the functions of the finance director and the organizational function of the finance, right? So I hope I have covered all the aspects of the financial management. So moving ahead, I am going to start the new unit, which is the time value of money. So as you know or understand in my previous slides, how time value of money is important, because on the basis of time value of money only we said that wealth maximization is superior than the profit maximization. So under this unit, I am going to cover the aspects of time value of money and understanding and concept and its importance, right? So why time value of money maximize the financial growth? So understand how much changes over time. Discover the principle of time value of money, essential for financial success. So time value of money will give you how much money you will discover in the future and how it is essential for the financial success of any of the business organization. It will also give you that idea, learn how inflation affects the purchasing power, realize the opportunity cost of delaying investment. And the third one is master time value of money for informed decision in financial management. So these three aspects, the time value of money cover financial success, a realization of a realized opportunity cost of the investment, and informed decision in the financial management. So time value of money will give you the roadmap and idea where to invest and where not to invest. So it will give you the clear picture about how will you take the decision for the investment. So this is the why the reason of the time value of money is important to be studied under the financial management. So these are the reason for the time value of money to be studied under the financial management. Number one is inflation. I hope everybody must heard about the inflation. So inflation is the part, because of that your purchasing power reduced, right? So if you will properly analyze your inflation in near future, you can invest at the better position. So inflation is the first aspect to analyzing the time value of money. The second aspect is risk. When we are talking about the discussion about the time value of money in investment decision, and whatever the investment we are going to make today, this investment will give the result in the future, and you know that future is uncertain, and because of that uncertainty the risk will arise. So analysis of risk is also too much important for in the time value of money. And then the third part is personal consumption preferences. Your consumption preferences may change. Previously, you must be understand that everybody trying to pull the car. Everybody used to go by public transport. Nowadays, Ola, Uber has made their choice different, and everybody wants to book the Ola, Uber from their app, and they want to use comfortably or ride comfortably. So the change of preferences, but it will increase your cost also. So if you want to analyze your time value of money properly for the future purpose preferences, you will get the good result in the future also. And the third and fourth one is investment opportunities. There are multiple investment opportunity, but which investment opportunity will meet your own requirement, your own goal, and your own perspective, you can analyze only by the help of time value of money analysis. So for these 4 points, the time value of money is important. So I have already explained here. I have given the some examples. Suppose investment opportunity. For example, if you have 1,000 can be rupees 1,000 can be invested in the fixed deposit for 1 year at the rate of 7% per annum. The money will grow up to rupees 1,070 at the end of 1 year. Therefore, given the choice of rupees 1,000 now or the same amount in 1 year's time, it is always preferable to take 1,000 now, because after 1 year, what will be the value of that 70? You can analyze today, and if it will give the positive result, then you should only invest, else you don't need to be invest. So for that perspective, time value of money is important. As I have already talked about the inflation part also, inflation is the fall in the purchasing power of the money. So it makes money cheaper and the goods and services costlier. Here you can see that, for example, you can buy 1 kg of rice with rupees 50 today. If the inflation rate is 10%, you need 55 to buy 1 kg of rice in a year from now. So you cannot say that today you are having 50 rupees and the same 50 rupees will give you the same value of purchase in the next, so after 1 year, because the inflation rate is increasing. So whatever the quantity or amount you are going to be purchased in 50 rupees today, it may be costlier in the future. So analysis of inflation under the time value of money is also an important aspect. Next reason for time value of money, risk. I have already explained you. Money received now is certain, whereas money tomorrow is less uncertain, because future is uncertain. Nobody knows about the future, and uncertainty will arise you the losses from your investment, not to meet your expected return. So uncertainty is also an important aspect. For that, risk management or analysis of risk is important, because with the time value of money. And personal consumption preferences, I have already explained. Now, how the concept of time value of money works. So this is the slide where I am going to explain you how present value comprises to future value, and how future value discounted to present value. So present value means today's value. If suppose you are going to invest today 100 rupees, this is your present value, and if certain rate of return will be there, and you will receive that 100 rupees at the rate of suppose 10% after 2 years, how much amount you will receive, it will be your future value. And if you are receiving future value of 150 rupees, what is their today's value, so how much amount is the value of discounting value will be multiplied with the future value. So present value compounded makes it future value, and future value discounted makes it present value. So this is the overall concept of time value of money. In the next slide, I am going to explain you in detail. See, the present value, the value of money today; future value, the value of money at some point in time; and the interest rate, the cost of borrowing, or the return on the investment. How much rate of return? What is the rate of return from investment? This is the interest rate. and the time period, that is the number of periods, year, months for an investment or the loan. It is also important. If you are putting the money for 3 years, there is a value of the opportunity cost also. How much, if you have not put the money on that place, you can invest somewhere else. So you can competition, you can get some return. So time is also give you the return, and there is opportunity cost related to the time also. So time period, analysis of time period is also important. So now, how can you calculate the future value for your investment? The future value, this is the formula of calculating future value. It is the present value 1 plus r to the power n, in which FV is what? Future value at the end of the period. PV is what? Principal at the beginning of the period. And R is the rate of interest per period, or N is the number of years. So this is the formula of future value. The second is present value. The present value formula is present value where FV 1 plus R 1 by R to the power n. So it is a 1 plus 1 by R to the power n is the discounting factor here. And in the first example, 1 plus R to the power 1 is the compounding factor. Means today 1 rupees will be compounded with the future present value and give you the future value, right? And today's 1 rupees and then present value will be discounted with the future value and give you the present value. So this is the formula of both future value and present value. Now here I have put some example for discussion of the present value and future value. You want to find the present value. This is the present value of 1500 to be received 4 years from now at the interest rate of 6%. So if you are investing 1500 to receive the 4 years, how much amount you can receive after 4 years if the rate of interest will be 6%. So this is the on the basis of the calculation, it will realize that you will receive the result. It present at the end of the 16 years, it is 1188 rupees. So 1500 rupees you are going to receive after 4 years. Then the present value of that 1500 rupees is 1188 rupees. So this is how you can calculate the present value of investment. Now this is another example of future value of investment. If you invest 10,000 in saving account by an annual interest rate of 5%, compounded annually for 10 years, calculate the future value. So which formula we will use? We will use here the future value formula, and this is the result. If you are investing 10,000, after 10 years, you will get at the rate of 5% interest, your value will be 16,288.9. So your value is compounded annually. And in this, in the previous example, your value is discounted annually. So both the value you must have to be analyzed. If whether you are satisfied with the 10-year value of this amount, then you can only invest. If you are not satisfied, you can take your change your decision as well. So this is the both the part. Why the time value of money? What level of analysis can give you the compounding accelerating growth, the returns, earned returns on principal and interest. So it is also important. The second is frequency. Annual, the frequency of the time value of money may be annual, semi-annual, or more frequent. And the third one is effectiveness. More frequent equals and higher yield. So this is the compounding and accelerating growth of the time value of money. Then why we should analyze where you can invest and how can you take the decision. For that point of view, securing your future retirement planning is also important. So how can you take your retirement planning? On the basis of analysis of time value of money. So first estimate income needs and today's money. How much income is required for future and what is your today's income, right? Then calculate required saving using the time value of money, and then start early. Harness compounding for the growth. If you will start early, you will make more profit in your future. So time value of money suggests that you should analyze it properly, then you can reduce your risk from your investment. So I think it is clear to everyone. Now moving ahead, this is the unit number 3rd, which is risk and return. So under this unit, I have covered a few points of understanding the risk and return and its type, return, and standard deviation and variances. So, this is your third unit of block A, and it is also very important when we are talking about the financial management. As finance is important, the time value of analysis is also important, and when we are talking about the time value of money analysis, the analysis of risk and return is also important. So it is I told you earlier also that all the financial management is based on the three decision, which is the investment decision, financing decision, and dividend decision. And when we are talking about investment decision, the risk is also important. And risk in investment, analysis of risk in investment, if you are more wiser at the time of investment, you will get the good result and profitable result in the future as well. So first of all, what is risk? So risk, what is risk? In financial management, risk refers to the potential for an undesirable outcome or loss stemming from uncertainty in the financial decision or investment. I have already told you, and again I am going to explain you, which you are taking any investment decision and you are going to make the investment today, and this investment will immediately not will give the return. So return will you will realize the return in future, and future is uncertain. If you have not done the proper analysis before investment, you will increase the level of your risk. If you have done the proper analysis at the time of investment, then it can reduce the level of risk of your investment. So risk, because of the risk, your expectation cannot be meet. Your expected return can be lower than your desired return. Your expected return cannot meet with the desired result return. So for all these purposes, analysis of risk is important. Uncertainty of getting loss from the investment is called the risk. In layman language, in another language, we can say that uncertainty, you are not certain how much you will get the return in future from that particular investment. So because why you are not certain? Because of the risk factor. If you are moving the car on the road and there is a too much traffic, every day you are taking 30 minutes, and because of the huge traffic, it is also uncertainty. You don't know how much traffic on that particular road. So this is also the uncertainty. So you are not committing your commitment of reaching in 30 minutes on that time. So uncertainty is creating the loss and the investment loss also. The variability of returns from those that are expected. So whatever your expectation, when you are putting any investment, at the time of investment you must understand or must keep some expectation from your investment. And if you are not meeting that expectation after realization of the actual return, only because of the risk factor. So risk is also considered as the variability of returns from those that are expected. Okay, so there are various types of risk which should be analyzed, and which impacted our the overall investment for the businesses and the companies and the enterprises also. So this is basically two types of risk. One is called systematic risk, another one is called unsystematic risk. The systematic risk is further categorized into the different parts. One is called market risk, interest rate risk, purchasing power risk, and unsystematic risk is also comprises of the two parts. One is business risk. Business risk may be internal risk or external risk, financial risk, credit risk, currency risk, country risk, and liquidity risk. So total risk of any of the business or the organization, it will be equal to the both systematic risk and unsystematic risk or non-systematic risk. So it is the equal of both systematic and non-systematic. So what do we mean by systematic risk? The portion of return variability induced by the factors impacting all enterprises is called the systematic risk. Diversification will not be able to mitigate such risk. Systematic risk means the risk which is impacted all the business organization. There is no legacy and there is no benefits given to any of the sector, and it is impacted to all the businesses and enterprises. And diversification cannot be also reduce such risk. It bound to be happen. So this is called the systematic risk. And this systematic risk is also known as uncontrollable risk. A company, a enterprise, or a business manager or a financial manager cannot control on this risk, and they don't have the capacity to reduce that risk, because it is bound to be happen because of the several factors. This such type of risk happen. So what are the following? There are the following some example of the systematic risk. The government changes the interest rate policy. When the government changed the interest rate policy, the corporate tax rate is increased. The government resort to massive deficit financing. The inflation rate increased. The central bank of the country promulgates a restrictive credit policy. Government fails to attract FII. So this is directly related to the government policy and the foreign exchange policies and export and import policies. So these risk can be arise only because of all these. And this systematic risk is also cause the market risk. Another bifurcation here, you can see that systematic, unsystematic, and these are the various types of systematic and unsystematic risk. So total risk is equal to systematic risk plus non-systematic risk. Okay, so systematic risk, another, this is the type. Now, what are the different types? So we have already explained in the previous slide types of systematic risk. Market risk. The first type is market risk. How can you understand what is market risk? So market risk involves the potential of investors to experience losses due to the factors that affect the overall performance of the financial market. This can include changes in market sentiment, economic indicators, and the global events. The overall, because of any of the happened in the stock market, any economic changes, any government policy changes, the stock market prices will be change, and flexibility in the stock prices. If any decision given by the Trump in USA, and because we are doing export and import, so these all our market are interlinked. So our because of the global events, globalization, our market sentiment will also fluctuate. So and all for that fluctuation of the reason, we are experiencing the losses from our investment, and this is called the market risk. The second important systematic risk is interest rate risk. This type of systematic risk arises from the fluctuation in the interest rate, which can be significantly affect the value of the fixed income securities. When the interest rate rise, the prices of existing bonds typically fall, and vice versa. So because of the fluctuation in the interest rate, the bond prices will fall, and because the bond prices or rate of the interest of the bond will reduce, you will realize the less return. And when the RBI government changing the policy, we have taken, if we have taken some loan, our interest rate will be flexible. It may be increased, so we may have to pay the higher amount of rate of interest, higher rate of interest. So this is also typically the interest rate. Because of the interest rate, we are also not able to meet our expected return. And the third, I have already told you, purchasing power risk, which is also known as inflation risk. So inflation, purchasing power risk arises due to the inflation. Inflation is the persistent and sustained increase in the general price level. Therefore, if an investor's income does not increase during rising inflation, then the investor is actually getting a lower income in the real terms. So because of the inflation, our purchasing power reduce. I have given the example in the previous slide. You can buy the sugar at 50 rupees 1 kg now. Because of the 10% of inflation, the same sugar price of 1 kg will be 55 rupees, and your purchasing power has been reduced. Now moving ahead, there is another types of risk, which is known as unsystematic risk. The unsystematic risk is the variations in the return of an investment owning to factors that are specific to the firm and not to the market as a whole. Unsystematic or unique risk is a type of risk that can be completely mitigated through the diversification. So, unsystematic risk can vary from company to company, organization to organization, and there are certain points and there are certain way. One of that is diversification, which can reduce the unsystematic risk. So there are following some examples of unsystematic risk is workers declare the strike in the company. Every workers cannot declare the strike of all the company, all companies worker cannot declare the strike. It may be happened with a particular company. So whatever the impact of that company, it cannot be equal to the another company also where the worker didn't go for the strike. So this is the another example of the systematic risk. R&D expert of the company on leave, a formidable competitor enters the market, the company loses a big contract in the bid, the government increases customs duty on the material used by the company cannot obtain an adequate quantity of raw material used of the company. So this type of risk is related to the company specific, organization specific. It cannot be impacted to all the companies in the market as a whole. So that's why some level it is somehow it is called the controllable risk, unique risk, right? So the types of unsystematic risk is also defined the two parts. One is business risk, and another one is finance risk. So business risk is related to a company's operations and business model. It includes the risk from the poor management decision in production issues, labor strike, or loss of customer. So may business may face these issues, and because of these issues, the risk can be arising, or the company or business cannot meet their expected goal and their expected desired goal. So because of that type of risk. Another one is financial risk, stems from the company's capital structure and use of debt, leverages, and highly leveraged company have a higher risk of bankruptcy. If the company is using the more debt financing, as I explained you earlier also, debt is the creating the fixed interest or fixed cost for the company. And if you are using the more fixed cost in your business structure, then you will may have the higher risk. And highly levered company have the higher risk of bankruptcy also. So here I have done some systematic and unsystematic risk analysis, a quick comparison. Here you can see that systematic risk affects market as a whole. Unsystematic risk affects is for the specific company and a specific sector, like banking sector. If there is a recession in the banking sector, it will happen to only banking sector. If there is a recession in the IT sector, it will happen to the IT sector also only. So it cannot be happen to all the sectors, pharmaceuticals, banking, in infrastructure in one go. So unsystematic risk can affect the vary company to company. The second one is diversifiable. Systematic, no possibility of diversification is not possible at all. In unsystematic risk, diversification somehow can reduce the risk of your uncertainty. Okay, and for example of systematic risk is interest rate, inflation, and unsystematic risk is poor management, lawsuits, trade union strike, and all. Another name of systematic risk is called market risk, and another name of unsystematic risk, which is a specific diversifiable risk. Now, what are the causes of risk for any of the business organization or any of the investment? There are some factors which can be stated to cause risk in the investment arena are wrong method of investment. If you have not adopted, suppose now AI is acquiring each and every manpower working, right? If we will not understand their AI working, what will happen? We will not invest it properly. So wrong method of investment is also give you the risk of investment. Wrong period of investment. So here in this slide, I am going to comprise or conclude it in the 3 points. For any type of investment, there are three important aspects. Is important. There are three important aspects. One is called risk, another one is return, and the third one is time. So for before doing investment, we must have to be analyze and introduce everything, analyze and analyze the time period of money. So thank you so much. I hope I am clear. Get clear all the points, and thank you.